everyone. This is Chris Baker with Keller Williams, and I have the famous Jeffrey Sachs on the house right now. So we're excited because we're doing this every month now, and one of the things that we wanted to do is make sure that we're big on education, training, and making sure that the consumer is aware of options, so you can make the most important decision of your life, which is not say important decision of your life, but one of the most financially important decisions about purchasing a home, and do it with the right information. And so Jeffrey, I've worked with Jeffrey for, it's been 15
years,
13
years,
it's been a while.
Something like that. Yeah, since the beginning, practically.
Yeah, so it's someone that I work with, I trust, and he's one of our preferred lenders that does some excellent work. And so I'd like to introduce Jeffrey Sachs.
Awesome. Thank you for having me, Chris. It's awesome. This is one of my favorite parts of the job, is actually being able to explain to people what it is that we're doing. I have a saying that I've been using for almost the whole 21 years that I've been doing this, which is the lowest rate on the wrong loan is still the wrong loan. So it's very important. How you finance a house is as important as anything else about what you get. So I'm really excited to be here. In the 21 years that I've been doing this, I'm a big fan of being able to do it the right way, and being able to do it, maybe present ideas that somebody else hasn't. The philosophy that often gets talked about is being an order taker versus a consultant. And that's when buying a house and financing it, there are so many different options. It's very important that the mortgage lender has the different options available, but also takes the time to really go through and understand what it is that we're doing.
So. Yeah, because I think, Jeffrey, when you're saying that, one of the things that we get all the time is that a lot of consumers come to us and they said, I want this, and they're so like, I gotta have this. And when you go through the question of why that's important to you, what's important about that, you discover that maybe someone just had told them some information and they didn't realize all the options that are out there for you.
Sure.
So today we're going to really focus on the conventional loan product. All right. And so there's an array of different options that are out there for as far as financing goes. But today we're going to specifically talk about conventional loan financing. And so one of the things, and the reason why I talk about this conventional loan, is because I think from a standpoint of diversification, it has a lot of different capabilities inside that product.
Really does.
Yeah.
It can go high credit score, low credit score. There's a few community lending products that they have in there. Home Ready, which is income based, available in certain areas. So there's just different aspects. Conventional lending has widened a little bit. And quite honestly, in Orlando, just with the price points that a lot of the homes are at, it's, in a lot of cases, it may be the only option over FHA and things like that. So just depending on where you are and what area, that's we're seeing a lot more conventional loans being done these days. The percentages are a lot higher. So.
Cool. And so one of the things too is, if you have some questions or you have anything, just send us a quick text or something while we're here, and we'll make some notes of that, and we'll be able to answer any of the questions that you have. So my first question for you, Jeffrey, what are some of the benefits of using maybe a conventional loan over maybe other products?
It's a great question. One of the benefits is usually going to be the fact that there's not going to be a funding fee and things like that are associated with some of the other lower down payment type loans. So you have the ability to put as little as 3% down without paying a funding fee that's almost the equivalent of 2%, like it would be on FHA. If you have the options to buy out mortgage insurance. And one of the real important things too, it doesn't matter as much long term, because people don't tend to live in houses as long, but on FHA, the mortgage insurance will be on there for the life of the loan, and on conventional, it doesn't need to be. You can have it dropped whether you're paying the principal amount down or it's appreciated over time. There are different criteria for that, but that's there's a lot of different reasons. But I think conventional loans right now are just kind of the appropriate. The fact that you can borrow up to $484,350 in Central Florida.
What is that? How much can you get?
$484,350 is the max loan amount. So what that means to a buyer is you can go up to roughly about $510,000 sales price and just put 5% down, or you can go to almost a little over $600,000 and put 20% down and still be in a conventional loan as opposed to jumbo. So.
Got it. Okay, cool. And so what happens when you go over that number, when you get into that jumbo world, what's really the difference and why that's important?
So with conventional loans, Chris, we have guidelines. right? So if you meet those guidelines, we give you a loan. With jumbo loans, it's not as easy. No one needs a jumbo loan. They want a jumbo loan. So the investors, all the jumbo investors that are out there, which there are numerous, and it's getting a little bit easier on that process, they more look at a loan like, why does this person need this, as opposed to with Fannie Mae and a conventional loan or Freddie Mac, we have the ability, if you meet the criteria, you get the loan. So it's there's much more certainty in the process. We had some customers that closed in July, and that was the situation. They wanted to do a 90% loan. It was going to be, like $650,000, and it was just much easier to do a first and a second combo. We actually saved money every month and didn't have to deal with the scrutiny of dealing with an outside investor for underwriting.
Cool, awesome. And so, one of the things that I know, we hear this, and this becomes a, like the mantra. Man, I can't get a mortgage without putting 20% down on financing. So can you tell me what are maybe some like breaking points as far as down payment goes for a conventional loan product, and what are some advantages and advantages of putting 20% down versus others? So
sure, putting 20% down is great if you can do it. This is where it's important for customers to listen to a good lender, or to have a good lender in their presence to be able to give some advice, because some people will literally take every dollar that they have to their name to be able to put 20% down in a house. And if you're saving $100 a month in PMI by putting down 20%, if all of a sudden you buy that house and you have no money left over, saving that little bit of money may not have made sense. So I always try to look at it from a combination. Before you're putting 20% down, have you paid off every other debt in your life? Student loans, car loans, credit cards. Those all tend to have higher interest rates and higher payments than any other debt that we have. So looking at making sure that those things are paid off is going to be one thing that's important. And also leaving a borrower with some cash. If you have 20% to put down on a $500,000 house, and you wake up a month later and you have a $500,000 house, but that whole $100,000 you had saved up that gave you peace of mind is now in equity in that house, that might be a little unsettling. So we always want to make sure that we're leaving people with a good combination of an affordable payment, but also keeping the right amount of money in the bank. As I've often said, the reason during hard times that people run into trouble is because they don't save enough money. In equity in your home, you could have a home that's paid off free and clear, but unless you can find a buyer for it and sell it, and that process can take weeks, you can't feed yourself at Publix with the equity in your home. So that's why I always, when you go through and they tell you it's $200, you can't just point in the direction of your home and say that's it. That you've got to come up with a credit card or cash or or a check. So I'm a big believer in,
because you don't have an ATM in your house.
Correct, and it's borrower specific. If someone has the ability, let's say, to pay cash for a house, putting down 20% would make all the sense in the world. But you want to make sure for that person. But even some people, I had a client, I've talked about this for years now, but I had a client who sold his house, walked away with $100,000, went into Wells Fargo, which is where he banks. He was told to put the whole $100,000 down on a $300,000 house and do a 15-year fixed. And the guy came to me. I had him put 5% down, pay PMI, do a 30-year fixed, pay off every bit of debt in his entire life. And from a cash flow standpoint, his total monthly payments, if he had done the Wells Fargo route plus all of his debts, he would have paid $4,500 a month in total bills. Yeah. He was paying $1,950 a month in total bills doing it the way we did it, and he had $15,000 left over. Wow. So imagine, here's someone who lived in their house for 20 years. That's where that $100,000 in equity came from. During that time, they had amassed massive amounts of debt, and because we put less money down and financed a different way, a person who made about $100,000 a year cut $2,600, almost $2,600, like $2,550 out of their monthly budget. Wow. And now when I showed him the ability to take that money and put it towards 401k, prepaid college fund, and then additional principal payments on the house, it took that situation and even exacerbated it even more than that. I mean, the guy was doing backflips. He was a Lockheed engineer. It was very hard for him very hard for him to think that he was about to go down the route and do the wrong loan.
Right. Well, that's awesome. You saved him a whole lot of money. I mean,
Yeah.
that's a lot of cash flow. That's tremendous.
Sure.
On a monthly basis.
It's life-changing is what it is.
Yeah. And so when you look at so the other reason why we hear people want to put 20% down is to avoid PMI.
Sure.
I mean, that's a good piece that we know that, mortgage insurance doesn't go to principal, it doesn't go to interest, it just goes to insurance.
It sure does.
So can you put less than 20% down and not have PMI?
You can. There's lots of different programs. So depending on where your credit score is, what I always explain to people is that there's a time and a place for everything. Okay, so if you need your debt to income ratio to be lower, so you have to eliminate PMI, sometimes doing where the PMI is built into the loan, but you're paying a higher rate for the life of the loan. So once again, if you're going to live in a house short term, that might be a good option. But one of the most overlooked options is just buying out the mortgage insurance outright with great credit. And this is something that's so wild, is that before the credit meltdown, mortgage insurance was standard. If you got a conventional loan, you were paying 78 basis points in mortgage insurance, and that has changed now where it's based on your credit score. They finally decided so if you have an 800 credit score, you are paying about a third of what you would have paid in 2007 for mortgage insurance.
Oh, wow.
Subsequently, if you have a 620 credit score, you are paying probably roughly double of what you would have paid then. So it certainly still pays to pay your bills. But you have the ability, I think mortgage insurance on a $100,000 house, a $100,000 loan, mortgage insurance on a 95% loan would be about $380 a year, or you can pay about $1,000, a little over that, and buy it outright.
Yeah, and so if you're going to be in the home for at least 3 years.
At least 3 years, then it's going to make sense.
That makes sense.
Correct.
Right.
If you had the ability to invest $1,000 and recoup, basically you're making $333 every year on that money. If you could talk to any investment broker and you could put $100,000 with them and you'd make $33,000 the first year, it's the best investment you can make. So it truly, as long as you know you're going to be in a house long term or hold the property long term, maybe turn it into a rental if you buy a small, relocate out of the area or buy a loan.
So obviously having an extra strategy, understanding how long you're going to be there, and then we know life happens and stuff like that. But
sure,
for a substantial amount, and so you can you get down to 5%, pay no PMI?
You can do 3% down and not have PMI.
Oh wow!
Yeah, you can buy it out at all those different levels.
Got it.
The great thing too is the program that I referenced very quickly. I glossed over. Fannie Mae has a program that's aimed towards first-time home buyers called Home Ready.
Okay.
And Home Ready actually has reduced mortgage insurance. So you can actually buy out PMI on that, and let's say your score is not perfect. Let's say you're in the 650s. It's a lot less to buy it out on that or pay it monthly than it is on a regular traditional.
Cool.
So
awesome. Cool.
Great option.
So we've talked about the down payment pieces and stuff like that. And so what typically when all of them are different. You had mentioned that with some of the other products, there's funding fees that are kind of associated with the loan.
Sure.
Where would you be typical closing costs that someone should expect for a conventional loan product? And I know it fluctuates.
Yeah. I would say between $4,000 and $5,000 is about the base. One of the things that's unique about our business is if you're buying a $100,000 house or you're buying a $500,000 house, the appraisal is still kind of the same process. Measuring the house takes a little bit longer on the bigger one, but most of the fees, a closing fee from a title company is going to be the same no matter whether it's a big loan or a small loan. So the doc stamps and intangible tax are really the only thing that go up or down. And then the other thing with closing costs that we don't know, if the property you're buying is in a homeowners association, there may be upfront costs associated with that. But I would say between $4,000 and $5,000 is pretty standard for the closing costs. And then you would have prepaids and escrows, which once again depend heavily on the property, the amount of the insurance, the taxes that are currently on the home. That could be another maybe $3,000 or $4,000, depending on. I'd say if you're talking a $300,000 to $400,000 house, that would be about normal.
See, and this is all the stuff that you can kind of go over with someone, up front to kind of know what the difference between those costs is, so they have a good vector to make sure that they have enough cash in order to execute the loan process and stuff like that.
Yeah, it's super important to go over all that. That's why also having an idea of where you're looking is important too, because some places, one county may have lower taxes than another county, so being able to give good information. Sometimes it sounds like you're you're being salesy, like, can you give me a property address to do this on, but it makes a lot of sense to give somebody, to take something they're actually looking at and be able to turn that into numbers for them. That can make the decision-making process a lot easier.
Because that's one of the things that we see is that all houses, all locations, everything's a little different.
Sure.
Everybody's has a little bit of difference. So even if you're listening to your buddy that said, I had this, right? His credit score might be much better than yours. It might have been terrible than yours. He might have been looking in a different county than you, different area than you. And so all those pieces is important to make sure that you're asking the right questions to your loan officer, as well as to your real estate professional, to make sure that you're getting the right information.
Sure. The information that you find online about anything, whether it's payments or how much money you need for closing, it's all so generic. There's nothing, if you have a 672 credit score and you're putting down 3% on Home Ready, that's not who they're quoting in those ads. It's totally different stuff. So it's very, very important to be focused on what it is you're actually looking at.
And so I would say the most common question I know that you get all the time is, what's rates doing now?
I knew that was coming. That train is never late. Yeah. So it's very interesting with interest rates. It is, it's not really the most important thing, but everybody thinks it is, and therefore it kind of almost materializes that way. Rates are great right now. We're seeing right now with the economy, we have an inverted yield curve, which is always unique for interest rates. But mortgage rates right now are very healthy. I would say we range anywhere, once again, credit score makes a huge difference in this, but we range anywhere from the mid to high threes, probably to the low fours on regular conventional interest rates. Your credit score is going to make a huge difference in that, a huge difference. But rates are really good. We have this trade war that's going on with China right now. This is very interesting, and a lot of people, we're having constant communication coming from our leadership group, making sure that we're having conversation with borrowers that if they're not locked in, they understand. If there's a trade deal that comes, let's say this afternoon they announce a trade deal between China, rates are going to go up as a result of that. They just naturally will. The stock market will thrive on that, and that will cause money to leave the bond market to go to the stock market, and you'll see rates go up, and it'll be quick. So it's very important that people are dealing with folks that are, that know what they're talking about too, because rates are important in having an understanding of how it works. But I've said this for a long time too. But if you like it, lock it. You can't go back. You can't go back and buy Apple stock at $20 a share. You got to pay $250 for it like everybody else. And that's the same thing with interest rates. So.
Got it. And so one of the things that I think too with the interest rate, I know that credit score is important. And so what are maybe some minimum credit scores that you see for conventional loan products that are out there that are standard, and where do you see those adjustments in, like, if your score's here, this is another break in your credit piece?
So 620 is our minimum credit score for conventional loans. I would say that every 40 points, 620 to 640 is one, or to 639 is one tier, and then 640 to 679 is going to be another tier, and then 680 to 699. Every time you go up one of those tiers, you're considerably improving your situation. I would tell you that it's at a 620 credit score, it's very important. This is a reason, Chris, I always tell people, if they're like, well, I'm not going to buy until next year, the best time to come talk to us, right? Yeah. Either they sit down and they find out everything is in line of where they need to be, or we can identify opportunities to make things better. Yeah. And if I have a year to work on your credit versus a week, it's a whole new.
I'm glad you really brought this point up, because we see this, and this is a common thing that a lot of consumers say is like, hey, I don't want someone to run my credit because I think it's going to ruin my credit, right?
Sure.
So talk to some advantages of maybe doing that up front, or maybe how do you address those concerns?
So in general, if you have good to decent credit, pulling your credit's really not going to affect it. But once again, no matter where your credit is, if you don't pull it, you don't know where you're at. So, I mean, I had a situation years ago where the gentleman wanted to, he didn't want to talk now. He was going to call me in January, the first week of January, and this was in like February of the year before. Sure enough, this guy called me the first week of January, like clockwork. Well, he had done it his way. He shut down every credit account that he had. He had no credit score. So it took us. Now, the bad thing about that was in 2010. It took until 2012 to be able to buy a house, and he finally did. Property values had gone up considerably. Like 2010 was like the low. So it was
a freaking great year.
Yeah, it was a missed opportunity there. So we have a lot of things. Credit is designed so it can't be easily manipulated. So what happens, it's very important for us to get in and work with somebody, have as much time as possible to allow things to naturally happen. And you can do some great things. We just had someone the other day that we took from no credit score to one of our customers. That, we got the son of credit score now. So
cool. And that was like what, 3 months, 2 months?
It was about 6 to 8 weeks. But there was a little bit of a delay in adding him to credit accounts. So
cool.
Yeah, but it's pretty easy. A month and a half ago we were talking about was this is going to work, and now we're looking at houses. So.
Yeah, that's great. And then so we talked about the brackets and all that kind of stuff, and kind of what we see. What are maybe some great strategies people can do to kind of maximize their credit score?
That's a great question. Honestly, it's more like going to the doctor. If you go to the doctor and say, hey, what can I do to be healthy? They're going to tell you the standard things, eat less, work out more, eat an apple a day. But if they have your labs and they have your x-rays and they have your history, they can give you a lot more information. Mm-hmm. So I would tell you that when we're looking at a credit report, I can give people a lot more better answers for what will work best for them. Mm-hmm. But in general, making sure you maintain credit accounts and you maintain them for a long time. Going to Home Depot and opening up a credit card for a week to do that, your chances are, if you're going to be doing anything else credit related in a few months from there, you may have actually increased your cost of doing of the next thing, the next car, or the next mortgage. You may have increased your cost because to save $15 on a purchase at Home Depot. So now you may be paying $30 a month more on a mortgage. So I would always tell people specifically, keep accounts, don't close good accounts, old accounts. You don't want to put more than 40% of what's available to you on a credit card. And really, you don't want things to go to collection. You really just want it, and the credit history has a history to it. So someone who has 20 years of credit history, their credit's a lot more resilient to things. I've got a fairly decent amount of credit that I've had for a long time. If I was to make a late payment on something, it probably wouldn't affect my credit that much. If you have someone who's already a mess, they have scattered lates all over the place, credit scoring uses patterns. So when things are stacked, when you have different things on a credit report, I would say that if let's say there's some late payments and there's a lot of inquiries and there's a lot of maxed out things, well, all those things add to one another and they compound. So you can take, whereas one of these issues of one late payment by itself is not such a big issue, having a high balance on a credit card is not such a big issue, but when you start combining those, it goes from instead of taking 5 points, 5 points, and 5 points together, all three of those might take 50 points.
Got it.
Very important to, even if you have perfect credit, I find that a lot of people don't know why they have perfect credit. Some people think they have perfect credit because they don't borrow money, but you have to borrow money in order to have credit, and
because you have to have a history of your success.
And while you're talking about things that matter, I always tell people this, having a low credit score, there are people who have low credit scores just because they don't understand what it takes to get a better credit score. Sometimes people confuse their identity with their credit score. I know some awesome people who have horrible credit. I know some not so nice people who have perfect credit. Yeah. So I would tell you, it's not a, different, everybody comes in different shapes and sizes. And everybody's got different situations.
And so one of the things that I meant to bring up earlier, but when we're kind of talking about the different products and stuff like that, a lot of times, when we talk about rates, right?
Yeah.
And I've seen that there's an opportunity if you go to a 15-year mortgage versus a 30-year.
Sure.
Are there opportunities for better rates at those?
Yeah, rates are usually, there's a little bit of a bigger gap. For the first couple of years that I worked in the business, it was almost a 1% difference.
Oh, wow.
So back then, rates were at 7%, and 15 years were at 6%.
Wow.
And it was a fairly big difference. A 15-year is a great option for people. Once again, for the right people. If you have, if you have debt and things like that, it doesn't make sense to pay off a house at an accelerated rate and leave these other debts out there. So we still see there's always situations where a 15-year is going to make sense, but I would say in a lot of cases when someone comes to me and wants a 15-year, I will present them exactly what they've asked for and then suggest some other things in the context that I'm just going to bring these things up. You can say, no, I don't want this, but you need to go in there and educate people. A lot of times, and I say this with as much sincerity as I can, like my father gives me advice or gives people mortgage advice, like I've heard, and it's what he would do. It's not necessarily what's the best thing for somebody.
Yeah.
So we often get that, we listen, our parents have instilled things in us, but our parents grew up in a totally different time. We wouldn't want, mortgages have been around since 1920s, roughly. We wouldn't go back, like if you had to, if you needed stitches, you wouldn't want them to do it the same way they did in 1920. Give you a bullet to bite on and a swig of whiskey, and then they stitch your arm out.
Yeah.
It's there's been so many advancements in everything, and just life is not the same. Back then everyone worked at the same job for 30 years and lived in houses for a long time, and it's just changing. So it's important. It really is.
Cool. Awesome. And then anything that, maybe I didn't leave out that you think, or actually, what are some things like when people are going through the process? This is like one of the things that, I'm sure you've heard all kind of crazy stories of things that people should do and should not do. And I would say should not do when they're interested in purchasing a home. What are maybe some of those like top 3 things that you see repeatedly? You say that this will completely jeopardize it. This will, other than like losing a job, we understand those kind of things, but
intentionally leaving a job, switching. And I mean, listen, if you're going from earning $80,000 a year salary to $100,000 a year salary, by all means make that move. We can deal with that. If you're going from making an $80,000 a year salary to becoming a fully commissioned car salesman, it's just not the right move at that time. It may be the right move for you, but just not right then. Yeah. I would say that changing jobs, like shopping for a new car, something like that, and car dealerships are notorious for pulling your credit 50 million times. And then I have a whole list of items that I give, like a warning sheet of what to do and what not to do. But transferring funds around a lot too is another thing. A lot of people have cash; they keep cash on hand. The sooner we find out about that, the better it is, because while you can never use cash for that transaction, if you've got $3,000 or $4,000 a month in bills, you can use cash to pay those bills, and therefore use that cash and leave more, in your bank account for us to use. It's definitely a good thing. One thing I meant to talk about a little bit earlier that I just wanted to kind of crowbar in a little bit.
Yeah.
We talked about PMI in a couple of different segments here.
Yeah.
There seems to be, and I'll go back to parents because that's where it seems to come from, but there seems to be a lot of pushback with PMI, like, oh, that's a ripoff, or this.
Yeah.
And I want to point out, there's one borrower in particular that I had a conversation with their father about 2 years ago. I'd done a loan for him in 2010. They bought a house for $140,000 in downtown, and they sold it for $320,000 in 2017.
Wow.
In that amount of time, the borrower had gone to college, taken student loans to the tune of almost $100,000 for a specific degree that he no longer worked in. Okay, started his own company, did very well, but he was able to pay off every debt in his life by selling that house that he bought in 2010. Now, when I talked to Dad in 2017 when he's getting ready to buy a new house, the dad once again reiterates that his son is not paying PMI no matter what happens. And even after I pointed out that his son is now debt-free, because of the fact that he got a house with PMI and he didn't have to wait until 2020 when he would have been able to save up enough money to put down 20%.
Yeah.
Still had that. So it's just one of those things. It's a great tool that allows people to buy homes with less than 20% down. And I just...
It's a tool in the toolbox.
Right. It's not a punishment though. And that's what I try to, once again, people hear bad things, this happened or this happened. And, it's, when I was a kid, I heard that the kid from Life cereal commercials, that Mikey, Mikey likes it, that he drank Coca-Cola and ate Pop Rocks at the same time. And like that, like you heard that urban legend. It's the same thing. Our parents are, constantly giving us this information.
That's not real? No.
Maybe it is. I could probably look that up. I've never, I should look that up.
Cool. So if we got anybody that actually wants to throw any questions that are out there too, feel free to just chime in with a response. We'd love to take some questions and stuff like that. So anything else that other than something that someone may not know about conventional loan that you feel like we haven't addressed that would be a benefit?
There's nothing super fancy. There's not, gone are all of the fancy options that we had for loans. It's just really, it's making sure, if there's anything I could encourage to a customer, it's to make sure that they are going into a mortgage consultation, that they're going into a mortgage consultation and they're not having their order taken somewhere, and then just to really sit down and take a look at the options that'll be best applicable for them. I mean, somebody may have a budget and they say, I'm not going over $1,300 a month, but if $1,300 a month payment means you have no money left over and you can be at $1,400 and have 20 grand in the bank, well, there's a big takeaway there. That's a lot of money. So people saving that, having a $20 a month lower payment is not going to make anybody sleep better at night, but having an extra 20 grand, or what would that equal? Probably 10 to 12 mortgage payments. Having that in reserve is certainly
So this is why Jeffrey's one of my preferred lenders, because we share this very similar philosophy about some of that stuff. A lot of people, like you said, like to just throw it all into the home, and I'm like, what are you doing? Leverage. It gives you a great leveraging opportunity and stuff like that. And so one of the things I do want to kind of bring up, and like for you to tell, and I can use, one of the benefits of using a real estate professional that has some experience is that I've been in the business for roughly about 15 years or so, and I've vetted great lenders, right? And so Jeffrey's one of these great lenders that are out there. And so one of the things that I remember, your loan process is freaking amazing.
Quick.
It's quick, right? And so there's some really significant advantages of having a lender that can actually execute what they say, when they say it, for when you're submitting offers. And so one of the things that I love about your program is typically you can do anywhere from 14, 21 days with that's
8 days from start to finish.
Wow.
Take a loan application, submit it on a Wednesday, and close the following Friday. We can do that on conventional and FHA.
Wow.
Yeah.
Did you guys hear that? Jeffrey, say that again?
We can close in 8 business days from start to finish, which is the quickest you can do by law.
Right.
So submit a loan application on a Wednesday and close the following Friday.
Wow.
I've actually got I've got one closing on Friday that I submitted last Tuesday.
Wow.
So
what's crazy about that is that he actually not only does, when he does this, he did it for me during Christmas. This is
yeah.
I don't even remember. It was maybe 2 weeks. I can't remember.
It's probably about usually most of them I got 2 week closings.
Yeah, it was 2 weeks, and we did it over the holiday period, and they still executed it great. And so what's advantage for consumers is when we're submitting an offer and we have a multiple offer situation, then when a loan looks like cash, because that's what it does.
Sure.
The only reason why someone's going to take cash is because it's fast. And there's less challenges. But when you can close a loan,
you can close in 8 days, or let's just call it a 2 week period, right? Because that's certainly enough. Most transactions have longer than that for an inspection contingency.
Right.
So think about that before, while that cash buyer still has time to change their mind based on an inspection they may or might not have done, you have the ability to go in there and close quick. Yeah. I can tell you that we have had numerous transactions that have been accepted over another one. I had one right after probably Labor Day of 2015, so about 4 years ago. we got a transaction that a house in College Park was in high demand, and it was a broker that had been working College Park for like 50 years. She took our offer, which was $2,000 lower than a cash offer. The cash offer needed 60 days to close, and we closed in 2 weeks. And it was the seller's carrying cost was only like $500 a month. It wasn't like she was saving back the $2,000, but they just wanted it over and done with. It wasn't a primary residence. It wasn't something they had emotional attachment to. They wanted it over and done, and we made it happen.
And so one of our tagline phrases is your Orlando advantage for real estate. And Jeffrey, I think you're one of those advantages that that allow our customers to get great opportunities, great deals, compete with cash offers, because that's a legitimate. I can compete with a cash offer when you can close that fast, and so. That's where we're in line with great people, and we hope that you'll take this opportunity. Jeffrey, if someone wants to learn more about kind of what you do and learn the process or have some more questions about maybe not just conventional loan products, because you do a whole variety of different things. I know we're just specializes on conventional loan products. What's the best way to reach you and get in touch with you and stuff like that?
Either text or call by phone. Phone number is 407-928-6481. Or you can email me, Jeffrey, Jeffrey .Sachs, SACHS @supremelending.com. Any questions you have, if you have a scenario you want to talk about or review things or just basically go through a checkup to see where you're at, I'd be happy to assist with that. And one thing, thank you very much for all the compliments that you said earlier. One thing I'd like to point out though, and this is something that it's not self-deprecating or anything like that, but I always tell people, we get a lot of feedback that tells us that we're doing the right things. And first thing I would tell you is my team is who does all that, right? I take a good loan application, right? Lori Bullock, that's my girl in Alpharetta, Georgia. I mean, she lives and dies for my customers. I mean, that's probably where it starts and ends right there. But what we do, Chris, is what we're supposed to do. And that's the thing I'd like to point out. And in this business, Bank of America may be your bank, but they're not in the mortgage business to be the best that they can be. They're in the mortgage business to serve their customers who are buying homes. We are really trying to do things differently. And so we don't go to our closings. We go to our closings because you're supposed to go to your closings, right? We call people back because you're supposed to. And I come around, right? I say, hey, Chris, you got any customers I can help out, right? Yeah. And if all of a sudden your customers were calling me and I wasn't calling them back, I'm cheating my family out of things, So really, I don't, it's not that I don't really try, really try to do a good job, but what we're doing that people are so impressed by is just, if we're supposed to close on the 21st at 9 a.m., we close on the 21st at 9 a.m., and then we try to fund always within an hour, that's, so it's the basics, I guess. I mean, really, I think for all businesses, it ties down to that, but what, Tom Brady may do some fancy things on the field, but the basics are what got it.
Right. Cool. Awesome. Did we got any questions or anything like that? Awesome. Well, we'll be here the last Tuesday of every month, interviewing one of our great preferred alliance or partners that we have, and we're glad to have Jeffrey Sachs here.
Thank you so much for having me.
Awesome. If you have any questions or you're thinking about buying or selling a home, come and talk to us. You can reach us at ChristopherBakerTeam.com, or you can reach us at 407-233-0812. Look forward to seeing you next month. Education, it's important. Know what you're doing.